Hey, what's going on, everybody? Hopefully, you guys can hear me, and hopefully, everything's clear. If you can hear me, drop a comment in the box. I'm gonna turn my screen on in a second, but just trying to get situated. This is not gonna be a long class today. This is gonna be pretty short, so I'm not uh, I'm not gonna be on here too long. But again, just kind of giving y'all the next phase in the mentorship. So let me know. Drop a comment in the box if you guys can hear me. Let me see. If you guys can hear me, drop a comment in the box. And we'll get started in a couple seconds. Again, this is probably going to be a very short class, like 15, 20 minutes tops. Maybe 30, but um, I don't think it'll take that long. Okay, cool. We'll start in like 2 minutes. Just want to finish something up real quick. You know the drill. If you guys are fast forwarding, I'm sorry if y'all are watching this on the replay. Just go ahead and fast forward. While we're waiting, how's everybody doing? How's everything with everybody? Hopefully, it's been a couple weeks since we had a chance to talk, so I want to make sure that um, stuff is sinking in, and obviously, I don't know how many people are on. It might just be a couple people, um, but I want to make sure that stuff is obviously sinking in. So if you guys have any questions from the past couple weeks, feel free to just hop in and hop in the chat and drop them in there. I'll be a full-time trader. Okay. Cool. All right. So homework is completed and awareness is definitely changing. Quest completed, and my awareness is definitely changing and identifying when to enter as prime priority. Cool. So what I want to do is just it's going to be slightly review with just a little bit more added on to it. So I think next week we'll talk a little bit about bias, like long-term bias, which is basically what I do on those calls that I do on the weekends, and that's basically how I put kind of a lot of the stuff together. But we have a little bit more before we get there, so just want to do a little bit more on the day-to-day stuff because this is really the bulk of what you're going to see as a trader. So knowing how to navigate these day-to-day situations. So again, coming to the terminal, right? Where this is going to be a little bit of review from last week or last time we talked about entries. So I'll outline both these days. This day right here, this was Thursday. I actually took a couple of trades. There's a couple of trades that I outlined in the chat. I think one was for a funded account, that Top Step challenge that I'm taking, that I'm basically keeping everybody up to date with in the chat. And that account, I think I started it Wednesday, and I'm up 1,500 on that, and I need to get to 3,000, a little over 3,000, 3 or 4,000, something like that, to basically pass that account and get a Top Step challenge. So I obviously am still funded with Apex, which is another futures firm, but just trying to grow the funding. And I think I was a little scared to go back to Apex after they had denied my first payout. So I'll probably get back to them eventually, but it's whatever. So right now I'm just obviously coming off of that 6 months or that 3 months, I'm sorry, where I was growing that $10,000 account to $40,000 in 3 months. Which, if you do the math, that comes out to about 120 grand a year, just in that account. So, but obviously you want to be funded with as much money as possible because it's better to use other people's money than your own anyway. So, as long as they're acting right. So what I want to do is just kind of go through the same thing we talked about last time. So again, being able to kind of take a lot of stuff that we talked about over the past few weeks, and putting them all together, right? So first thing we're going to do, and again, this is a trade setup that I took on Thursday, again, for that 1,500 on the personal account, I think 2,600 on the live account. So good there. I'm sorry, 1,500 on the challenge account and then 2,600 for. So you notice this again, this stuff starts to be like clockwork, again, because it's algorithmically driven. So when we talk about consolidation, manipulation, and distribution, and overlapping those things with the liquidity markers and how to know where price is going to go, right? And we talked about the idea that power of three is how the market moves. Liquidity is why the market's moving, right? And where it's going to move to, right? So coming in, this is going to be our Asian session range. Again, 8 o'clock that previous day, which is 20 on the clock, to about 1 a.m., 1 a.m., 1:30, right? So in this case, our situation was a little bit different. And it actually, the movement actually started a little bit ahead of time. So what did we get here? Well, we got the consolidation, right? We got the manipulation. Oops. Yep, we got the consolidation right here. We got the manipulation. And then distribution, right? And obviously distribution came all the way down here. As far as entries, right? Actually, it went further. Oh, wait, this is Friday. No, this is Thursday. Friday starts here. So yeah, so this is our distribution. Obviously power of three, right? If we're thinking about a daily candle, the candle would have started like this, right? then it would have went up higher, wicked, and then went down for the rest of the day, right? So when we talk about power three, again, it's going to be how the market's moving, right? Liquidity is going to be the reason why the market's moving. So obviously, this is the 15-minute time frame. This is our bellwether chart. We know we're never going to enter on this time frame, right? So let's hop down and go down to the 5-minute time frame. Again, we talk about consolidation and manipulation. Um, consolidation and manipulation. What do we have here? Well, we had this manipulation that happened around 1 o'clock. If you missed this initial move, again, 2 o'clock would have been the entry that you probably would have been looking for, because that 2 to 5 window is London. And I'm going to draw a line here that goes from 2 to 5, right? And this will be our London session window, right? And so obviously this is where we, get the first look at our entries at, right? So what do we have here? We see price, runs up, forms a fair value gap right here. Not only does it form this fair value gap here, but if you look closely, these are relative equal highs, meaning that these highs are equal, but they're not really, there's a buildup of liquidity here. They're very similar. And this would, again, when we talk about relative equal highs or relative equal lows, you want to think what the logic here is. Could a trader put a stop loss over here because they could see this as resistance? And so what happens is whenever you have a series of highs like this, again, retail traders will think this is just resistance, right? Or this is strong resistance. So let me start to go short here and put my stops above these highs, right? The same thing that happens at the beginning of Asian session, right? When price is trading in a range, right? So like all the way up here, we zoom out, we know there's money above these highs, right? So what happened in the middle of London is that price formed these relative equal highs, came up there, got it, still stayed inside of this fair value gap. And if you look closely, the bodies really respect the consequent encroachment of this fair value gap. And if you can't see the top end of this gap, it's because that wick is right there, but it's very faint. So it's the color of my candles are white, so it's kind of hard to see. But from that low to this high, notice how, again, price set these relative equal highs, came back up there, took price out, and then ran lower. But when you're looking at this, I want you guys to notice how all of these bodies pretty much stayed under consequent encroachment. So at one point, this is a full white candle. It's trading all the way up here. It looks really scary, but then it wicks, right? And it just crosses above consequent encroachment. And the next candle breaks right below consequent encroachment. So it's, basically this was a good way to stop out the traders who would have got the situation right because they went short. And so a lot of times you have to kind of notice that, see if there's any relative equal highs right above your entry, because there's a chance your price could get stopped out. But we would have entered into this probably here, and our stop loss probably should have gone above the candle that forms the imbalance anyway. So our stop loss should have been up here. And so if we're looking at this kind of in a replay, I'll show you guys really quickly, and I'll make this very quick. I'm gonna have fun with this number today. So let's do this. Oh no, was it not? There we go. I'm gonna slow this down a little bit just so you guys can see this more realistically. Once price re-enters that fair value gap, I'm selling. And price goes above that high, that stop loss, that's that red orange line right here. That kind of represents my stop loss and where I think the market should respect in order for us to maintain this trend. So what happens is I'm initially up in this trade. Everything looks good, right? Everything looks good. Everything looks good. I'm losing money. Now I was up 3,000. Now I'm not. We're forming these relative equal highs. That's a sign that we could go up there and purge. Again, my stop loss should stay above this high. right? And it's gonna come back up here. Right, comes back up there initially, and we're negative for a second, right? But it didn't touch our stop loss because our stop loss is always going to be placed above the candle that forms the fair value gap, right? So this high right here in this case. And obviously, if we were in this trade, we'd hold it to the end of London, right? And this is where we would kill that, right? So coming to the terminal again at 7 o'clock, right? We know what we want to expect. And this was the trade that I'm actually going to get rid of this. So you guys can just look at this. But this is actually the trade that I took on Thursday. If we go back up to that London session, is we saw the market really form these highs. And I actually took a trade, and my private group knows this. My private groups knows this. I was outlining this to them as it happened. Again, if you are in that private mentorship, you guys are getting like obviously more insight than I do on this channel. But initially, there was an 8:30 news release that happened, and I thought price was going to turn around and trade here. So I actually ended up taking a trade in this range right here. And obviously, I wanted to short this. There's a lot of good things here. We had trendline liquidity built up. We'll talk about that another day, how the market uses trend lines to build liquidity only to take them out later. But I basically entered in this gap here. And then I thought we were good initially, especially when this market broke like that. But the market ran up one more time, took out this old high here, which is again the high, a very prominent high of New York. And if I go to the 15-minute time frame, you guys can see that. It came all the way back up to this high here. And why? Because we know what sits over this high is going to be buy side liquidity. So when we come to that New York session, immediately, and I outlined this to the chat, immediately, we should be thinking that it's going to probably be a continuation of what happened in London, unless a higher time frame objective is met. And we'll talk more about that when we talk about bias. But ideally, most of the time, a London session will be a preview of what happens in New York. So if we had a bearish bias here, most likely what will happen is we'll run to a level of liquidity, an old high or an old fair value gap, and we'll run down. Now, what happened here is prior to the session, I outlined a couple levels of buy side liquidity that I thought the market could run to. And I'm just going to get rid of this so you guys can see better. I thought the market could run to this high here or this high here. And there was also an 8:30 news release too. So what happened for me is that prior ahead of time, I outlined, 3 levels: this fair value gap, that buy side liquidity, and that buy side liquidity that I thought the market could run to. Because again, we want to see the market sweep liquidity. And so what happened is, as we got closer to 8:30, there was a huge news release. It's called CPI. It happens, regularly. I thought they were going to use that news release as an opportunity to take price where they wanted to go. And so I saw the market run past this high and have a hard time breaking it. And I figured, okay, cool. There's buy side above this high because, again, there's buy side liquidity over any high, right? Old highs and new highs. And so I figured, okay, when price struggled to get through this, there's probably a good opportunity for us to go short. And that's what I did. And that led to that first initial trade, which actually was a loser. So again, seeing price trade back up into this range here, I thought this was a good, qualification of our setup, right? So we had a run of liquidity, right? We had a break in market structure, and then price traded back into this gap. I was like, okay, cool. This is go time. We have a buildup of trendline liquidity there. We're easily going to run down off of this. And so this is why you have to manage your risk effectively in every trade, because a lot of times, I would say the majority of the time that I'm wrong, very rarely am I wrong because my directional bias is off. I'm usually wrong because the sometimes it's just the market's not ready, right? And so this is why you have to protect your trades at all time. Because if I would have went all in on this trade, I would have been sick, right? When this thing went against me and then eventually tanked. But this trade failed, right? So this is my stop loss would have been up here. I think I actually put it right there. So it took me out right there, and that would have been a loss in the day. So I stayed with this because, again, my original two levels, and this is probably me jumping in a little early, but my original two levels that I called out prior to New York session, again, this is obviously New York session here, were these two levels. So I wanted to see what happened when we hit these highs, especially since we still had this buildup of trendline liquidity there. And so what we actually got a few minutes later, like less than 30 minutes later, is price hit this level here and then just completely tanked, right? And so when we talk about our New York session setup, again, it's going to be a continuation of what happened in London, but it's also going to have this, the same characteristics that we look for in London. It's just going to be a little less clean than you'll see in London. What does that look like? Okay, running above a previous high, breaking structure, open into that fair value gap, and then price tanking. So if we jump down to the 3-minute time frame, we can see this a little bit better. So price traded back to an old level of buy side liquidity, right? And for visual purposes, I always put money there because over every high or every low, you should immediately think buy side. Right? And so take off that high. Boom. Then what happens, right? So now that we took out this high, we need to see the market break structure. And ideally, we want to see the market break structure cleanly. Technically, the market broke structure when this happened here, but this is a little choppy, right? So I like clean, very clean stuff. Like I like to see price be very, very clean when it gives me the things. There's no confusion. You could look at this and say, even before this happened, you could look at this and say, well, technically the market broke structure when it took out that low here. Like this is a low, a higher high, lower low, right? But it's very choppy. So I like to see stuff that's very plain, right? Because it just gives me more confidence. And when you start risking 200, 300, 400, 500, 1,000, 2,000, $5,000 on a trade, you want to be sure of what you're looking at, that you're seeing the right thing. So there's a couple things here. The first thing I saw was we did end up breaking structure, right? We broke structure here on that 3-minute time frame, and then also making known of what time it is, right? It's just outside of our 10:30 window or 10 o'clock window. Because today was a news release day, I kind of pushed it to 11. And a lot of times what I'll do is if there's a huge 8:30 or 10 o'clock news release on those days, I will kind of extend my window a little bit, an hour. Um, so yeah, so we had the fair value gap open up. We broke structure by taking out this low there, right? And if you can't see after that last candle, this is what it looks like. High, higher low, high, breaking market structure when the price takes that out, and definitely when price trades all the way down with that wick, right? So we have broken market structure. Then what's the next thing we want to see is a fair value gap open up, right? So I'm waiting on price to trade back into this when this happens, right? I want to see the market do that, and then I'm going to enter into a position again. Same situation, right? And we see the market trade back into that. So just for visual purposes, let's sell. Where does our stop loss go? Well, I was a little conservative, so I put stop losses above the high of this candle, I believe. It could have been a little higher. It could have been above this high. But, this basically lets you know, like when the market's ready to go, it will go. Like it will run, right? And you see all of this buildup of this trend line liquidity here. right? All of that, especially if you go to the higher time frames, that 15-minute time frame, you can see that market build up like that. There's a bunch of sell side under this market, and essentially what the market to do with trend lines. I don't trade trend lines. I don't buy bounces off of trend lines, but I recognize that under all of these lows are going to be sell side liquidity. And whenever you see the market have like an obvious trend line pattern like this, it's probably building it up to take it out, right? Because there's going to be a bunch of dummies that will buy these bounces off of these trend lines, thinking the price is going to keep going higher. And we're in an overall downtrend, so you shouldn't be trying to buy anyway. But that's usually what happens is that the market will form these highs, form these levels like this to bait traders into putting stop losses underneath here. So when I saw this kind of happen, obviously with the first initial trade, that was a loss. That was the reason why I took the initial trade right up here. And so hopped in right here, targeted these lows, especially when you started seeing another thing too. Here are these relative equal lows. See how all these lows are even, and price has a hard time breaking through here, right? So I'm sorry, price doesn't break through here. So anytime you see these lows where it looks like traders just can't break through, it's like that, and they're not being purged. Like none of these lows are dipping past this initial low. It's letting you know that the market is trying to bait traders into putting stop losses there. So you have these relative equal lows here. You zoom out, all this trend line liquidity here. There's so much sell side liquidity under this low and under these lows, so that you already know the market's going to want to come back down there and revisit that and kick in those people or kick out of those people that are trying to go long. So what happens here? What happens next? Stop losses above the high, right? We entered into the trade there. Boom. And this is just a fun day, right? So this was probably one of the fastest trades that I've taken this month in terms of getting to targets. Like, I mean, this is the 3-minute time frame. So 3, 6, 9, 12, 15 minutes. I mean, it pretty much ran to target, right? And that was for, a collective for 4,000 across 2 accounts. So the challenge account and the personal stuff. So, and it even really gave you signs it was going to continue to go lower. I think it did go lower after this too, because it was filling old fair value gaps like this. So what I want to do really quickly before we hop off again, so that was Thursday's trades. There was also a setup on Friday. I kind of let you guys outline that. But the main thing that I want you guys to understand and come to the terminal every day, it doesn't matter if you trade one session or the other. I tell everybody that's in the private mentorship that I'm only really looking for 1 or 2 good trades a week, right? Because if you find that one good setup, and obviously it depends on how much, you're trading with, but one good setup can last you, basically make a week's pay, right? Or it can, be enough to cover you if you have your accounts built up. So for me, I'm only really trying to check the best setup possible. And I'm not trying to take everything. So a routine is really good. So for me, I'm a New York session trader. I can't trade London session. I used to do that in college. I used to do it a little bit after college, and I don't have time anymore. And I can't stay up till 2 a.m. every day and trade till 5 and be functional, right? So for me, I'm a New York session trader. So my trading window starts at 7 a.m. every day. So I'm just going to put that line there. So I'm coming to the terminal asking myself what happened in London, right? Okay, well, we were bearish. We didn't hit our major low that we should have hit, like our higher time frame target, which again, right now, you guys don't know how to do that. So don't worry about that. But, you come to the terminal saying, like, when you do figure that out, or we do teach that next part, you have to ask yourself, did we hit our higher time frame target yet? Okay, cool. No, but we're probably going to keep continuing based on what happened in London. So coming to the 7 a.m. session, we're going to run and grab liquidity, or we're looking for a level that we could run and grab liquidity. These 2 very prominent highs were, again, areas that we could run to. So run on the old liquidity, which is what happened when we took that out. We're going to see break market structure. want to see formation of a fair value gap. We want to see price really run to lows. Again, initially I thought this was going to be it. When we took out that old high, we didn't, but we came up here, did the same thing, and price just tanked, right? So one of these a week, right? And then over time, you're learning how to scale your skill set, scale your accounts, grow things, a little bit bigger. As far as, trading on a demo account, I can't tell you guys legally, I can't tell you guys to trade live. Um, but just learning how to do these things on a demo account, watching price over and over and over again, so you can see this stuff play out day in and day out, so you're confident that it's going to happen when it does. But you can learn how to do these things by taking one trade a week or 1 2 trades. So I would challenge everybody to pick a session, whether New York or London, and for the first couple months, especially since we're running to the end of the year, but the next couple months, maybe through December and January, you're just sitting there and watching price during your time, and you're drawing out what you think is going to happen, and then you think it's going to go down. And then if you think it's going to go down, then looking for basically the same setup, right? That run on old liquidity, right? And if I had to label this run on liquidity, then what happens? The break of structure here, then the fair value gap right here, which price trades back into. So this happens over and over and over again. And how you should read this, because again, we don't want to trade patterns for pattern's sake, but how you should read this every single time is, this is basically a transaction, right? It's once you stop looking at candlesticks and you start seeing order flow and basically like what the market's trying to tell you or do, then it becomes less about trying to trade a pattern as much as it's just trying to read what the market's doing. So we know that the higher time frame was bearish, right? Which is why we expected the market to go down already. Coming into this session, we know that in order for the market to kick in these sellers, right, it has to go get buyers first, right? Which is the whole idea behind Power of Three: consolidation, manipulation above an old high to grab all this money up here, so we can take this money and match it to the sellers down here. In order for us to, every buyer needs to have a seller, every seller needs to have a buyer. So if you're bearish on the day or you think the market should go down, you need to ask yourself where are the buyers at, because we're going to run to those levels first. Kick in those people, get that money, get those orders, and then match those orders up with the people down here. So that's why the market will always go up before it goes down. It's why the market will always go down before it goes up, because it needs to get the opposite liquidity first and then match it up, right? So again, I tell my students this all the time, but I say, like, where's the money? Where's the money? Where's the money? And if you can ask yourself where the directional bias is, where's the money we got to pick up first to get there, and then where's the money that we're going to match things up with, you can accurately pick what's going to happen a lot of the time. Not every single time, right? You're going to be wrong, right? And a lot of times you will have the direction right, but you'll be wrong about the trade, like this, right? I was right about the direction, but I was wrong about the trade. And that's why you protect your trades, right? You need to make sure that you are not just risking it all on one trade, because there's nothing worse in the world than having a trade that you take a loss on, but you had the direction right, and then 5 or 10 minutes later it goes in your direction, and you're sitting there looking like a dumbass because you basically blew your account or you blew your challenge, and either you don't have any more money to trade with for that, for that day or that week or whatever, or you're too scared to hop back in because you just lost way too much money. So it's kind of like, I think of every trade as a jump shot, right? It's not, you're not going to make every shot, and you really shouldn't try to make every shot. You want to take the best shot possible for what the offense or what the defense is giving you, right? So you want to make sure that you're doing the right thing over and over again. And once you figure out the trend is going in your direction, okay, cool. Well, there's opportunities to hop in this run and capitalize on trades. So for my personal account, I think I gave myself a 3 contract max for this particular setup. meaning that I only would take, this is obviously 30 and this is like $7,000, a lot of money, but this is not really what I traded with. But um, I give myself like a three contract max, meaning that between my entry and my target, I could only use three contracts, right? And that just kind of helps me manage my emotions, manage my risk, because if you lose $100 or $200 on the trade up here, it's, yeah, it hurts. Obviously, your loss hurts your ego, but it's not as bad as having your ego hurt and then losing 10 grand or 5 grand, right? So you want to make sure that you're risking the appropriate amount of risk. Um, so yeah, so I had a three contract max, and that was enough. I think I scaled into five on the on one of the accounts. So I can't remember which one it was, but yeah, I mean, you can see how it doesn't. You don't need a lot to make a lot of money, and you don't need to risk a lot to make a lot of money. You just need to be able to catch the runners, and you can definitely scale into things when stuff starts going your way. But initially, managing your risk is the most important thing, because once your psychology gets out of whack, you are cooked. Like, you're cooked as a trader, so you can't take you if you'll try to overshoot the trades that you try to make more money to make it back, and you start revenge trading and you'll blow an account. And I got a lot of stories about blowing accounts. um a lot of stories about blowing accounts that I can tell y'all. Coach, that happened to me for years, and it just happened to me not too long ago. Patience is a key factor. So yeah, so Tony, the thing about trading, man, is that, like, you got to come to the realization that while you are learning, you are doing just that. You're learning, right? So, like, if you go to college, right, or you go to a trade school, or you go to school to learn something, right, you don't expect to know, like, if you're in high school, you don't expect to know how to do algebra 2 or trigonometry, right, your first day of freshman classes. You got to work your way into that, right? um, you don't expect to know senior level classes freshman year. You don't expect to make money with your education the first day of freshman year of high school or college or whatever. Like, you guys are learning, and that's exactly what it should be. You're just learning. And even if you start taking trades and you start making money, right? Like, while you're learning, that's cool. But um you gotta know that uh having those ups and downs, and you're not gonna be rich overnight, basically, like, right? And I also struggle with this whole, like, putting a lot of my trades publicly, because I don't want to give y'all the impression that this is easy. It's not easy. It's not easy, right? And so you're managing a lot of things. You're looking at the charts, you're looking at setups, you're also managing your emotions in your head every single time you trade. So it's like, it's one of those things where you have to consistently, like, balance uh, a lot of things going on. It's not easy. It takes years, and you never, your emotions will always be there. You always have the little devil on your shoulder that says, "Fuck it, just put all your, go all in," right? Or, "It's gonna go in my direction. Let me keep scaling in, scaling in, scaling in." Like, you're always gonna have that monster telling you that. But if you don't learn how to control that, then you're gonna blow your accounts. You're never gonna really be a good trader. You're gonna have this constant cycle of ups and downs and ups and downs and ups and downs. And so you need to be able to manage that as great as possible. Um, so yeah, so patience is that key factor, and also killing, like, having discipline over the amount of days you trade keeps helps a lot of that too. So for me, the number one reason why I tell you guys, like, look for one good setup a week and call it a week, is because even though there's setups every day, the likelihood that you're gonna emotionally be able to manage those things um, is kind of low, because, how can I say this? You're gonna you're going to like, when you win 10 trades in a row or five trades in a row, you start to think you're Superman. And when you lose 10 trades in a row or five trades in a row, you start to think that you can't get, you don't know what you're doing. You can't see what's going on. You don't know like, you start to doubt yourself, right? And all that stuff plays into your emotions. And so it's so much easier to come into a chart, look for the best possible setup that day or that week, look for your setup, right? And take it if you see it, then and do that once a week, and then kind of get your mind right, come back and do it the next day or week or whatever. Than trying to trade every day, because you'll ruin yourself emotionally with that. So I'm basically trying to give you guys, one day a week, or one week where you're trying to actively trade, and trying to find the best setup. And obviously, once you make that day, like, you could trade maybe a day or two until you find it. You're not always going to have the same day you sit in front of the laptop as the day you're going to take that winning trade. It's not always going to happen like that. But once I hit that winning trade for the week, I'm usually done. And if I manage my risk right, I usually will either A, be in profit from, because that'll be the first trade I take that week, first or second trade that I take that week, or it'll basically um, cancel out all my losses for the week. And so for this, I think I lost like $300 or $200, and made like $1,500 back on one account, and then 2,500 on the other. So it's, hold on 1 second. It's one of those things where it's one of those things where managing your risk is probably like key. And I know everybody says that, but it's like, really, if you can't manage yourself, then you'll never be able to manage your risk. If you're an impulse driven person, it's probably not the thing for you. But the last thing I want to do, and then I'll kind of like wait for some questions, is I want to go down to like a 30-second time frame, and I want to manage this trade again, and kind of show you guys what it's like to be in a trade, how to manage it. And again, I'm only going to the 30-second time frame because I just want to give you guys a lot of candles and a lot of examples. Um, but I don't ever really go down this low. So this is where we sold. So I'm going to bring things back to here. And I'm going to sell right here, right? Again, this is because that's where we sold last time. Put the chart up here. So the number one question that you should need to ask yourself as a trader, sorry about that, guys. So my computer had a little technical difficulty there. But really quickly, again, what I want to walk with you guys through is basically just um, how to manage a trade. So basically, when you're in this situation, it's easy to see, okay, cool. Um, this is how you got to the low, Blake. Like, okay, I see you took this trade and it went all the way down here. But how did you have the confidence to know that it was going to get down there? And this is basically managing the trade, right? And so obviously I'm jumping down to a very small time frame because this example was very small. But but just to show you guys again, and we'll talk more about this next week. Probably have a couple more examples. Is the questions you need to be asking yourself is between your stop loss, your entry, and your target. How do you know your trade is still valid? And this will probably be the conversation next week too. Um, but if you're looking at the time frames, the reason that you know that your target shit is going to hit where you think it's going to hit is because it should be continually making running towards old sell side between your entry and your target. So we know under every low is going to be sell side liquidity, right? Under every low is going to be sell side liquidity, and under every high is going to be obviously buy side. So when you're in a downtrend, you need to start thinking of downtrends as sell side seeking uh, models, right? Or you might hear me refer to it as a market maker sell model, meaning that we're really trying to pick up sell side liquidity. So the reason that you should be confident in these trades as these runs happen is because you should continually see the market forming new fair value gaps on the way to your targets, and you should continually see it running after sell side. The minute it starts forming, it starts running after buy side, but like with a break of structure, or stops taking out lows and stops forming new fair value gaps, is the a reason that you might want to either take profit or get out of the trade before it hits your target. And there's going to be days like that too. There's going to be days where the runs are going to be very choppy, or they're not going to go straight to your target, right? So as you can see here, obviously this was our initial entry here. We traded back up into that old fair value gap. And then what happened as we zoom in, we formed a low. We came back down and took that low out. We formed a new fair value gap here. So this is letting us know that the run that we're on the way to the target that's all the way down here is still valid. So what happens next? That next minute candle, boom, what happens? We take out this sell side low here, right? We also take out this sell side low here, right? These are very prominent lows, at least in this time frame, that we know there's going to be money sitting under. Why is there going to be money sitting under these? Because we know that there's a bunch of traders who saw this happen and they jammed their stop losses underneath here. So anytime you see an old low, you need to start again, think sell side. Right. So then what? What happens? Market takes out these lows. What does it do here? It forms an order block. As I pause this, it forms an order block, trades slightly above it into what? Another fair value gap right there. So it's forming new fair value gaps. It's respecting these civvies, right? So when you're in a downtrend, you need to start looking for these things to see if they're going to hit your targets. It's respecting the civvy, it trades back up into it, respects it, and continues to trade away from it on its way to the longer time frame target. Forms that order block there. Once that happens, we know that price should not trade back above that order block again. And what else does it form? Boom. A fair value gap right there, but not just a fair value gap, a fair value gap, which the third candle there is also a volume imbalance. And see how that's a gap between those two candles? All of these things are signs that the market wants to continue to run towards those levels. And so a lot of times what I do is if I have a fair value gap and that last candle forms a volume imbalance, I just drag that down because it basically has to trade back up into that, or should respect that, right? So basically on your runs down, you should be seeing liquidity markers that form that are showing you, that the market wants to respect this run. Civvies, old order blocks, and once they form, price should respect those. So in theory, once price trades all the way back down here, there's no way in the world that price should, I mean, it can happen, but the majority of the time, price should not trade back over this order block. If we see price trade back up into this range, or if it starts inverting old fair value gaps, and what I mean by inverting is not respecting. So if price were to just do something like this, price were to just trade back and not respect this at all, and just come through that, that would be a very alarming to me. Like I would probably close my trade out, or I would get out quicker, um, or I would at least move my stop loss up, because I don't like that. I don't like, it should respect this if we're continuing looking for sell side. it should respect this order block. If it's not doing those things, then that means it could have found its target. The target it was hitting for could have been this low right here instead of the one that I originally called out. So while you're doing it, looking at that run, you continually have to manage these things. But know that if this is a higher time frame target, like I'm on the 1 minute, if this is a 15-minute low or a 5 minute low, in this case, this is the low of the day at that time. So there's a really good opportunity that the market might run to that just for that reason. So kind of have to think about these things as you're managing the trade. But in this run that you're seeing on the way to that target, you should see, if you're bearish, you should start to see BISI or CIVIs form. Again, CIVIs are going to be sell side imbalances, buy side inefficiencies, or down fair value gaps, right? I draw them all as red, but you should start to see things like this play out over and over, right? And the market should respect these, right? It shouldn't trade back and trade through these on a sell side run or a sell side model where we're in a downtrend going after levels of sell side liquidity. You should never really see these disrespected. Um, and if you do, that's alarming. It you might want to get out of that run early and call it a day, or move your stops up. Right, my stop is all the way up here. They move your stops into profit seal. That's at least a profitable day, right? If price comes all the way back up here, then at least you clear. You locked in $100 or something like that, or whatever a percentage of the run is for you, right? Um, in this case, I probably would have moved my stops all the way here because of that order block. But at least one thing you don't want to do is see a run come all the way down close to your take profit, or even just well into profit, and then watch it all erode away because you're not looking for what's going on. So again, ideally, if you're in a sell side run, you should be seeing new CIVs open up. You should see new order blocks being respected, bearish order blocks like this one being respected on the way to the targets. Same thing if you're going the opposite direction, right? On this, if we were just to look at this run right here, you can start to see that BISIs, again, were being respected. So this would be a BISI, right? A buy side imbalance, too many buyers, not enough sellers, right? So that, you see another one right there, right? You see on this up run, they're being respected until the market breaks structure and then it starts attacking those levels. So in a downtrend, you should always see these CIVs respected. You see all order blocks respected. And again, I draw order blocks, like I treat order blocks very much like gaps, where I'll measure from the body to body. And ideally, I would want to see the market respect consequent encroachment. And a lot of times, because the market is algorithmic, you'll see these things line up, right? So notice how consequent encroachment of this order block is very close to the upper end of that fair value gap. So you'll start to see these things play out over and over and over again. Um, and no, this is all it's all big computer program, man. This is all big video game, and this is nothing to be scared of. It's something to take seriously because you're putting money on the line, but it's nothing to be scared of because like when you sit down and you play, I don't know, Madden or 2K or whatever game, right? You're not scared of the game. You know the rules of the game. If I hold the button down long enough, I'm going to make the shot. The problem is that most traders don't understand the rules to this game, and that's why they continually lose money over and over and over and over again, right? And they don't respect the game, right? You got to manage the risk. So again, you see how the market took out those lows and then ran to, I think it actually took out these lows. Yeah, killed that. And actually, we just tanked the rest of the day. I think the rest of the day was crazy. So again, you should be when you're looking at a run, and we'll talk more about this next week, is how to manage the trade when you're in it and where to move your stops up to, how to manage those things. And I think that'll be the last thing before we start to talk about bias. But you should be able to effectively manage a run, and how to know if prices might not get to your target or how to know all those things. So we'll talk more about that next week. I'll pull some more examples up for you guys, but hopefully that makes a lot of sense. Hopefully you should be able to start looking at the runs on your own and start to notice things like, okay, cool. Like, on an uptrend, okay, we're forming new BISIs and prices are respecting those bullish order blocks, or prices respect, we're on a civvy and a down run, and price is not respecting those levels anymore. So hopefully that makes a lot of sense to you guys. So let me go to these comment sections really quickly, and then we'll call it a day. And also, shameless plug. Like I said before, you guys know this by now, but I am going to be mentioning this over the next couple of weeks. So basically, I'm going to be teaching down at this 2-day summit down in Miami on December 14th and 15th. It is going to be the Level Up Institutional Summit. It's put on by a good friend of mine. His name's Chris Munoz. He's a really phenomenal trader himself. He trades mostly NASDAQ. We both trade the futures. We've known each other for years. We actually went to college together. And he's a really good trader. And he's put on this summit. And a lot of times what happens at these summits are basically, traders come into these rooms, and they just hear people on stage kind of like stunting about like how much money they made, how great they are, and they don't really walk out with anything other than motivation. And so what we wanted to do for this summit is kind of change things and make things a little different. We wanted to put together something where people can actually come and get value and actually become a better trader technically on the charts than what they would, have done in the past. So what we're doing is putting together again a 2-day summit. You're going to come, you're going to learn these strategies with us in person. You're going to be able to kind of spend time around us and kind of see how we look at the charts. It's going to be a weekend, so the markets will be closed on those days, but we'll have a lot of examples for you guys. We'll be able to kind of see what the markets are going to look like going into that next week. Obviously, you'll be able to ask a lot of questions, and really see like what it's like to be a trader on the day in and day out. And I know a lot of times people look at social media, or even like I'm guilty of it too. Like I put stuff on Telegram, right? And I might only show winners publicly, right? But it shows you the mental kind of fortitude of a trader, what we're thinking about, how we should approach the markets, how you should approach the markets, and really giving you a lot of information that will be taken, and you know you can learn from it and actually walk away with something positive, instead of just seeing a bunch of people on stage with a lot of money and a lot of cars and stuff like that. So that's going to be December 14th and December 15th in Miami. um, I think we're gonna have a location for you guys pretty soon. Um, just to show you guys a little bit of the flyer. If you are interested in coming, give me, um, let me know, and I'll send you the link um, to the Telegram. I'm sorry, to the link to the Telegram, link to the actual summit. But here's a picture of again the summit there, or the flyer for the summit. But yeah, check it out, and hopefully we see you guys there, and hopefully you guys learn something in person. I'll be teaching a lot about the currency futures. I think that's going to be my niche for the next year or so. But I think it's a lot easier for people to learn, and I think it's obviously the market that I see the easiest. I love Nasdaq a lot. I love trading Nasdaq, but I think a lot of people could benefit from learning how to do this. So I'm deciding to really kind of make this my forte for the next few months or 2 years. So I'll still do the breakdowns on Nasdaq, but I don't want people to focus on that because I won't be focusing on it. I'll really be focusing on trying to teach this. So yeah, so you guys have any questions, let me know. But yeah, patience is a key factor, Tony. um, it's there's a lot there. So hopefully you guys got a lot of value out of this. And then if you didn't, I'm sorry. It's free anyway. It didn't cost you anything. So again, follow me on Telegram. Go back to the chat, and maybe like the message. Let people know that you enjoyed something, you got something out of this, and obviously the recording's there for you guys to view in the future. So I'll let you guys go. And if you guys have any other questions, feel free to let me know. But that's all I got for you guys. So peace.